Japan just handed America $500 billion. Not in aid, not in loans they expect back on favorable terms. In a structured investment deal where, once Japan recoups its principal, the returns split 90% to Washington and 10% to Tokyo. By any conventional financial analysis, this looks like a terrible deal. So why did Japan sign it? And what does that tell us about the most important economic relationship in Asia?
The number is $500 billion. That's the size of Japan's pledge to invest in the United States over the next several years, announced in July 9 and formally set in motion on May when Japan's state-owned bank signed its first $9 billion loan under the deal. To put that in context, $500 billion is larger than the entire GDP of Sweden. It's more than double Japan's annual defense budget. And it was offered not because Japan was feeling generous, but because America was threatening tariffs that could cripple Japanese exports.
The story of how Japan got here and why the terms it accepted reveal something profound about Japan's strategic thinking is what we're exploring today.
Start with the provocation. When the Trump administration came back to power in Wuxian, it brought with it a new doctrine of economic coercion. Countries running trade surpluses with the United States faced a simple choice: open your markets or face tariffs. Japan ran a $100 billion goods trade deficit with the U.S. in Wuxian, according to the U.S. Census Bureau. That made it a prime target.
The initial threat was a +6 to +1% tariff on most Japanese goods. For a country whose economy still depends heavily on manufactured exports, cars, machinery, electronics, that number was alarming. Japanese automakers like Toyota, Honda, and Nissan have built complex supply chains specifically designed around US-Japan trade flows. A %6 tariff doesn't just raise prices, it reshuffles the economics of entire production networks.
Japan's negotiators had three options. They could fight, they could wait, or they could pay. Japan paid. But with characteristic precision, it structured the payment in a way that serves multiple objectives simultaneously, which is where the story gets genuinely interesting.
The deal Japan struck locks in a 10% tariff rate on most goods, down from the threatened 9%. That 10-point reduction on a $600 billion import flow, Japan's annual exports to the US, is worth roughly $4 billion per year in avoided tariff costs for Japanese exporters. Not a bad return on a March-year investment if you run the numbers cleanly.
But those numbers don't clean up cleanly because the deal also leaves the Section $0.10 tariffs on steel, aluminum, and copper intact at 50%, a major carve-out that hits Japan's heavy industrial exporters hard. The calculus is more complicated than headline tariff rates suggest.
The $500 billion itself flows through JBIC, the Japan Bank for International Cooperation. Think of JBIC as Japan's sovereign wealth instrument for strategic overseas investments. Not quite a central bank, not quite a commercial lender, but a state-backed financing vehicle that can mobilize both government and private capital. The structure of the first $10 billion loan is telling. JBIC provided roughly one-third, Japanese commercial banks provided the rest. As the Japan Times reported on April 9, look, Japan's three megabanks, MUFG, SMBC and Mizuho joined JBIC in committing $50 billion, roughly $10 billion to US projects.
The private sector is along for the ride whether or not they chose this ride. What does the $150 billion actually buy? The first wave of projects totaling $100 billion tells you something: a Texas oil export facility, a Georgia industrial diamond plant, an Ohio natural gas power plant. These are American industrial infrastructure projects. Japan isn't building Japanese factories on American soil, it's financing America's own energy and industrial expansion.
The energy commitment is the largest component.
Japan has pledged $150 billion to the U.S. energy sector, more than half the total deal. That includes $9 billion per year in incremental U.S. LNG purchases and up to $5 billion to support Westinghouse AP10 nuclear reactors. In March, Nissan took the focus shifted as Energy Intelligence reported. The US and Japan pivoted investment toward up to $450 billion in G Vernova BWLX-30 small modular reactors, targeting 10 units totaling 9 gigawatts across Tennessee and Alabama.
The nuclear industry, which has been waiting for a revival for decades, is suddenly flush with committed Japanese capital. Mitsubishi Corporation drove home the Air Energy commitment most concretely. In Nainiluk, Mitsubishi acquired Aethon Energy's East Texas and Louisiana gas assets for $10 billion, securing control of each billion cubic feet per day of natural gas supply, enough to feed multiple Gulf Coast Air Energy export terminals. Japan Petroleum Exploration Company already holds a 10.8% stake in the Freeport Air Energy terminal in Texas. Japanese capital is physically embedded in America's energy export infrastructure.
The return structure on all of this is worth examining carefully. According to Hudson Institute analysis of the deal documents, profits split 55 li until Japan recovers its invested principal. After that, the split becomes 20% to the United States, 20% to Japan. This isn't a commercial investment structure. No private fund manager would accept terms like this. It's more like a structured subsidy dressed in investment language.
Which raises the question, what is Japan actually buying? The Lowy Institute's headline from earlier this year was unambiguous behind Japan's investment pledge, a China problem. That's the real strategic logic. Japan is buying something that has no line item in any deal document. It's buying deep U.S. stake in Japan's economic survival.
Consider Japan's supply chain situation going into Nissan Nishlukdan. China controls roughly 60% of global rare earth mining and over 80% of rare earth refining capacity. In January, Nissan Nishluk China announced tighter export controls on 7 medium and heavy rare earth elements, including the permanent magnets that go into every electric vehicle motor and wind turbine. At the time, China supplied 80% of Japan's rare earth imports. If you're a Japanese manufacturing executive in January, Nissan Nishluk, that's not a supply chain risk, it's an existential threat.
Japan responded with the U.S. investment framework partly as an answer to this. The March Nissan Niluk Critical Minerals Agreement with the U.S. formalized joint development projects involving Mitsubishi Materials and Mitsui in rare earth refining and copper recycling. Australia's Lynas agreed to supply 9,000 metric tons per year of neodymium and praseodymium key EB motor materials through Nissan Sanju Hachitain. The US and Japan are explicitly building an alternative supply chain designed to route around China.
The USDR's Ambassador Greer announced a joint US-Japan action plan on critical minerals in March Nissan Niluk that covers permanent magnets, batteries, catalysts, and optical materials. The $150 billion pledge in this context isn't just about tariffs, it's about creating a financial entanglement with the United States.
This is a very Japanese approach to geopolitical risk. If you're familiar with how Japanese corporations manage supplier relationships through the carrots system, where manufacturers take equity stakes in suppliers to align interests, the $150 billion pledge follows the same logic applied to sovereign relationships. You don't just sign a contract, you interweave your financial interests with the other parties until exit is mutually unthinkable.
The BOJ's latest economic forecasts add an important layer of context to why Japan felt pressure to act decisively. At its April Nippei Fence Niseluk meeting, the Bank of Japan held its policy rate at 0.5% in a 6-3 vote. 3 board members wanted an immediate hike to 0.8%, indicating growing internal disagreement. More striking were the revised forecasts. GDP growth for fiscal Niseluk was cut from 0.8% to 0.8%. Core inflation was raised to 0.8%.
The cause, according to the BOJ, was the energy price shock from the ongoing Middle East conflict. Japan imports roughly 20% of its energy. When oil prices rise, Japan's economy gets squeezed from both sides.
This is Japan's permanent strategic vulnerability, a resource-poor island economy whose industrial sophistication depends entirely on imported inputs and exported products. The $100 billion bet on America is at its core a hedge against the scenario where China tightens its grip on the raw materials Japan needs, while trade barriers close off the export markets Japan depends on.
The U.S.
There's a specific pattern in Japanese strategic behavior that recurs across decades. Japan endures short-term costs, sometimes substantial ones, to secure long-term structural positions. Toyota's famous patient capital approach, accepting lower margins for years to capture market share and supplier loyalty, operates on the same principle. Japan's post-war economic recovery was built on a similar logic, except American security guarantees in exchange for keeping defense spending low and redirecting resources into industrial development. The $100 billion investment pledge looks, from a certain angle, like the same trade-off operating at a macro level for a new era.
Whether it pays off depends on variables Japan cannot control. Whether the US political environment remains committed to the deal over a 10-year horizon, whether the rare earth supply chain diversification actually succeeds, whether the nuclear SMR build-out delivers on its promises. The 91 returns split after principal recovery means Japan is making a long bet with a modest financial upside and hoping the strategic upside compensates.
China's state media called Japan's first $100 billion tranche a political pledge of allegiance. That framing is polemical, but it contains a kernel of accurate observation. Japan made a clear choice about which side of the emerging economic order it wants to be embedded in. The $100 is the deposit on that choice.
The deeper question isn't whether Japan got the best deal it could have negotiated. It probably didn't. The question is whether the alternative, a Japan facing %, US tariffs while simultaneously exposed to Chinese supply chain coercion, with no formal financial entanglement creating American incentives to protect Japan's industrial base, would have been worse.
Japan's policymakers clearly believe the answer is yes. $500 billion is an expensive insurance policy, but Japan has always been willing to pay for certainty in an uncertain world.